Hello everyone and welcome to TTT Markets. I am Fotis Papafeofanos and today we are going to discuss how volatility changes the way you should trade. Because most traders think volatility is just market moving faster. But volatility changes much more than that. It changes trade behavior, risk, timing, your psychology, the market structure. And one of the biggest mistakes traders make is trading the same way in completely different volatility conditions. So in this video, we'll break this down directly on the charts. I will use EURUSD and $yen, and I will show you why volatility should change the way you trade. So first chart, we are going to open a EURUSD. So here is the EURUSD chart, and I have selected for now the 4-hour time frame so you can see the big picture. Let's start here. Look at this section first. Let's take a look, for example, this period. What is happening right now? Right here. This period. What is happening? We have some larger candles, but not too large. And then we have smaller candles. We have smaller movement within a range. It is not getting anywhere. And we have a stable structure. You can see this. We have the highs, we have the lows, and it is moving within this structure. Now let's compare this to another area. Let me find a good one. For example, here, this one. What do you see here? Compare the size of this candle, for example, in this regime with what happened inside here. We have larger candles, we have much faster moves, and we have aggressive reversals, for example, here. So it is the same pair, but completely different behavior, completely different regimes. And again, large candles, it is moving faster, and you can see this. If I switch to the 1 hour, you will see that it is moving places faster. It is reversing in a much more emphatic way. However, look at this period. Small candles, range, not going anywhere. So completely different behavior. So why does this matter? Because a strategy that works well here may perform terribly over here in this regime, because volatility will change your stop distance, the trade duration, the momentum behavior, the execution quality. And this is where many traders struggle. This is where many traders struggle, and they apply the same risk and execution to all environments, exactly the same. Let's make this practical. Let's look at these candles, and I'm using the 1 hour time frame. We have a larger movement, larger candles, fast expansion. Now imagine if you are using a stop, let's say over here, which is below the fractal low over there. You place a stop below. So what happens? The price is fluctuating, your stop gets hit, and then it goes your way. And if I zoom out, not only it goes your way, but it goes your way, and it could have been a great reward versus risk. So this is happening constantly in volatile condition, not because the idea was wrong, but because volatility required more room. However, in this area, you can see where we have a tight range, small candles. You can place a stop below, you can buy, and nothing happens. Why? Because we have low volatility. So you often need smaller position size, wider stops, more patience when you have larger volatility, for example, in this regime over here. And when volatility calms down, again, you can use different kind of setups. So professional traders adapt to this. Retail traders often don't. But why don't we use another example? with dollar yen, which is usually a volatile pair. Here we go. So what do you see? Common retail mistake. So many traders, this is a 1 hour chart, they see this move and they say, okay, let me buy here, I will place my stop below the fractal. But what is happening? High volatility creates emotional pressure. The moves feels urgent. I must buy because I will miss this. Let me go ahead and buy. I will place my stop below. But this is quite a volatile session. It moves down. It breaks the trend line. Your stop gets triggered because, after all, probably you did use a stop below the trend line and then continues going your way. And this is another dimension of volatility. It does create poor entries because of the emotional pressure. So it creates poor entries, emotional execution, and increased risk. Professionals understand this. They don't let volatility force decisions. And this is very important. Volatility doesn't only change price, it changes trader behavior. So notice this environment. We have large candles over here. You can see we have large candles. We have no clear follow-through, no clean follow-through, and this is creating psychological stress. You see this, you say, right, I must sell. It goes down, range. Can you see this if I use a trend line? There you go, and this is the high. So you see the large candle, volatility, you say, right, let me go ahead and sell. You sell, comes down, hits the bottom of the range, comes back up. This is creating emotional pressure, psychological stress, because traders start reacting emotionally in this kind of regime. They try to enter too quickly, so you don't miss the move, and you are closing maybe too early, you are losing confidence, it comes right there, you think, oh gosh, I just can't chase it anymore. You sell, you place the stop above, it gets triggered, and then what happens? Boom, it crashes. So the environment is affecting your execution. But this is not only with higher volatility. Lower volatility has problems too. Some traders will say lower volatility is easier. Well, not always. Low volatility, for example here, lower volatility, it does create fake breakouts, slow movement, and you get tired. Lack of follow-through. Well, here is where momentum strategies struggle. So if you are using a moving average, something like that, you will struggle because trades become slower and less efficient. Again, it's the environment changes what works. So the environment changes what works. So what do you need to do? This is the real skill. Not predicting volatility, but adapt to volatility. So professional traders constantly ask, what type of environment am I trading in? Because that determines risk size, expectations, trade management, and selecting the right strategy. So what you need to do is, in a calm trend, pullbacks are cleaner. So if we have usually the same size of candles, we have a calm trend, pullbacks are cleaner. Let me now switch to 4 hours so you can see. Entries are cleaner, calm environment. Entries are easier. The trend is up. You say, okay, let me buy on pullbacks. The stops can be tighter. But if volatility is expanding, reversals become more violent. So sell the highs, buy the lows. And risk increases significantly. You can't say, oh, I will sell there and place my stop above. Your risk is becoming too big. It's the same pair, but two different trading behaviors. Now, why many traders become inconsistent? Because they think my strategy stopped working. Well, it's the market volatility that changed, and your execution failed to adapt. What professionals focus on? They analyze the conditions. They ask, is volatility expanding or contracting? Here we have trending market, here we have sideways market. Here we have more stable volatility, here we start having expanding volatility. Is the movement stable or unstable? Does this environment support my strategy? So this creates better decision making. So what is the conclusion here? That volatility will change your behavior, and if market behavior changes, as you can see here, then your trading approach must change too. Why? Because if you wish to be a successful trader, you must pay attention to your structure, your risk, your timing, your psychology, and your execution quality. You cannot just say, oh, I will just switch a strategy to give me a different signal. No, you must pay attention to all those things. It is not enough to have a strategy. You need to understand the environment you are trading in. Remember this, in trading, the market is never static. And when volatility changes, the way you trade should change too. I'm Fotis Papatheophanos. This is TTT Markets. See you in the next video.